capture. So we got to get something that captures what's happening on the TV screen. And then we got to also have a camera like the Zoom that captures. So you'd have to have like an OBS type deal. And you would have to have those color cables run through some kind of capture card that records it, and then we can, they make them. They make the RCA capture card. I used to have one. I'm surprised it didn't laying around somewhere around here.
I really want a GameCube, bro. I'm pissed off that Elise was being a bitch.
Let me see. Hold on, you. Damn, it's recording, man. Yeah, there's a little delay to it. See, what I was doing was I was playing, and then I would plan this
spread, but you can still make money if it goes down just a little bit. So first, you're going to want to start with shorting a put option closer to the strike price that the long put option you're going to be buying later on. So we're going to start off this example by looking at a short put option at $98, and I'm going to be buying a put option at $94. For selling the 98 put option, I will receive a premium of $1.50, and then I'm going to buy a put option at 94 strike, and I'm going to be paying 50 cents. That gives me a net credit of $1. So I'm going to get paid $1 to trade this spread, and that's going to be $100, and that's going to be our maximum profit. That means that my break even is going to be at 97. So I need the stock to stay above or at least at 97 to make any money. But we want both of our puts to expire worthless, so we get to keep the premium that we collect. To calculate our maximum potential loss at expiration, we need to find the width of our spread, which is $4. Then we just need to subtract what we got paid in the first place to put on this trade, which is $1. That leaves our maximum loss at $3 or a real max loss of $300. So if the stock goes down a lot, it's not going to be good for our short put, but our long put is there to protect us on the downside and cap our maximum loss. And just like the bear call spread, we're essentially risking $300 to make a potential $100. Pretty simple, right? So for me, a put credit spread is literally one of my favorite strategies, and I'm going to go over an example right now and show you how the put credit spread works, how much money you can make put credit spreads, and we're going to go into those details right now. All right, let's talk about put credit spreads. So let's go over an example right now. I'm going to use Apple stock. So I'm going to click Apple right here, and then I'm going to open up a put credit spread. Actually, you can see right here how I'm up 380K on the stock, and it does make up a significant portion of my portfolio. Again, if you want to see all of my picks, I do have a link in the description where you can actually check out my community where I post every single trade that I make. Now let's go to trade Apple options. The first thing I'm going to do is I'm going to sell a put option. Now, the best expiration date really varies, but anywhere from 1 to 6 weeks is going to be perfectly fine. The reason is because options actually expire. The reason is because theta, or time decay, actually kicks in very heavily in the last 1 to 6 weeks, specifically in the last week, but going 6 weeks is also perfectly fine. Now I'm going to pick an expiration date that's going to be in the future. Let's go for an expiration date that's 1 month out. Now what I'm going to do is I'm going to sell a put option. I'm going to sell an out of the money put option on Apple. And what I'm specifically looking at right now is delta. I want to sell a low delta. The lower the delta, the lower the chances are that the option is going to expire in the money, which is a good thing if you're an option seller. I'm going to move up right now to the 220 strike, and you can see right here that the delta is 0.19, which is pretty good. That means that I'm going to win about 80% of the time, and 20% of the time, this option will go into the money. So that's perfectly fine with me. I'm going to go sell put option, and then I'm going to click right here. Now, if I were just to make this trade right now, you can see here on the top right, it says cash secured put. So I'm just selling a put option, but to actually make this a spread, now we have to go ahead and buy a put option. So first we sold a put option, now we're going to buy a put option. For me, I like to buy a put option one leg down, typically. I really like the width of $5. A $5 width is pretty much the best. I'll tell you why. If you're doing spreads that are $1 width, it's not ideal because every time you're trading, you are actually losing a little bit of money because there's something called the bid and ask spread. Here the bid is 1.3 and the ask is 1.35. That means every time that you're trading, there's a little bit of a difference, actually a couple of dollars that you're losing out on. So if you're doing a lot of quantity of, $1, $2 spreads, that's not ideal. I'd rather do a $5 spread and do a little bit lower quantity, but lose less money when I'm making the trade. There is implicit cost and explicit cost. This is going to be an implicit cost because it's not really factored in, but you could factor it in yourself because now you know. So I'm going to go ahead and buy this 215 strike price, and now you will see something very interesting. So now it says put credit spread, and the difference is $5. And you can see here I have a net credit of $75 or roughly $75 to $80. That is actually going to be my max profit. My max profit is what I collect on this option trade right here. So let's just say $80 is how much I'm making, and I can lose $420. Now, why is it $420 and not $500? Well, when I'm making a $5 with spread, that means I'm risking $500. But because I'm collecting $80, that means that the difference is going to be $420. So at most, I can lose $420. My max profit is $80. My max loss is $420. Now, let's talk about risk management. Risk management is super important if you want to properly make money on a put credit spread. Now, let's be honest. If you make $80 and then you lose $420, obviously you are in the hole. So how do you end up actually making money? Well, there are several ways. First of all, this spread right here has a very high chance of being out of the money or has a very high chance of you profiting. By using technical analysis and by using good intuition, picking the right stocks, you can tilt the odds even more in your favor. That's exactly how you make money trading options. This is actually a very hard game to play because everyone in the world wants money and everyone is playing this game. But if you want to tilt the odds in your favor, you're going to pick high quality companies, you're going to use out of the money options, and you're going to use proper technical analysis. Now, in terms of closing this position early, if this position goes into the money, you can think about closing out this position. So for example, if Apple goes down to 220 from the current stock price of 235, then you can start thinking about closing out this position for a loss and managing your risk. Okay. So if it goes to 220, you can ask yourself, do I think it's going to go lower? If yes, then you can close out this position. If you're still bullish on the stock and you don't have to use Apple, you can use any stock, then you should basically not close out this position. I have noticed that the biggest raw returns that I get, the biggest returns period, is by holding the option until expiration. And that's what I teach in my community because I like simplicity. I like to do the least amount of work and make this income as passive as possible. However, there are people out there, especially many of my students who are engineers, that want a system. They want to know exactly when to close. Well, the bad news is that option trading isn't really a science. It's much of a science as it is an art form. So for me, every situation is a case-by-case basis. Sometimes I will close, and other positions I will hold until expiration. For the majority, I hold until expiration. And I've had situations where I was down like $15,000 only to wait until expiration and be up like $15,000. So $30,000 difference just by waiting and being patient. So it's not always the case that doing more makes more. In fact, in option trading, doing more sometimes makes less. Now, for the best stocks that you should use for a put credit spread, again, you want to use high quality blue chip stocks. And something that you don't want to do is, for example, I'm going to show you CMG. This is just as important to avoid as it is to trade properly. Now, Chipotle has had a stock split, so this isn't as good of an example, but before, and I'll show you what I mean by this, but before, when this stock was really expensive, it was extremely hard to trade. For example, the bid and ask spread was very wide. Now, check this out. This bid and ask spread is actually 15 cents off, which is $15 off. Very different from Apple. Apple was like $5 off. This is 15. That means every time you trade, although your brokerage could be free, this is still going to be an expense of like over $5, $7, $8 potentially. So this is really, really bad, especially if you're opening up multiple legs. Now, check this out. This is going to be completely what you don't want to do, all right? So let's say I want to sell a put. I'll show you exactly why I do $5 with. So these are really weird because of the stock split. So check this out. Let me go for 62. Let's do 62.3. All right. I'm going to sell this and then I'm going to buy, let's say 62.1. Let me show you how whack this is going to be. This, like, look at this. You see, it doesn't even show you a risk because these options are so illiquid. They're so bad. Like you see 460 and 730. That is so bad. In fact, it's so bad that Robinhood is telling you that there's a maximum profit of $50 and no max loss. But that's incorrect. You're just not going to get filled. Like if I click continue here, you'll see that the bid is negative 230 and the ask is 330. like literally, it is going to be very, very difficult for you to get assigned or even like place this trade. You're just not going to get filled on the trade. That's really, really bad. So it says 0.5 here. And, if I were to enter 0.5, the chances of this actually getting filled are very, very slim to none. So, I mean, if I were to put in 0.2, yes, maybe this would work, 0.2, but still, this would be an example of a very bad bid-ask spread to trade. So it's really important to pick the high-quality companies, and it's really important to pay attention to bid-ask spread. So let's talk about how to use all four of these vertical spreads. When would you want to use them, and what outlook are you looking for in the stock? So specifically, what you want to do for the bull call spread is that you're expecting the stock to go up. So you're looking for a stock that's bullish. When a stock is bullish, using the bull call spread will give you money. You'll make money. And that's a specific strategy where you're buying a call option that's closer to the money. So you're going to have a net debit, but you have a whole lot of money to make. If it goes up, this is literally the best strategy. I've made so much money on Tesla by doing it.
Learn how I use private trading networks to earn $24,000 a month in passive income and escape the rat race in less than 6 months.
If I were to rate everything that I'm doing right now, you guys would be number one, without question.
It's beyond my wildest dreams, honestly. Not a lot of people know about this.
On a scale from 1 to 10, I'm going to give ATN a number 10.
In my world, ATN is ranked right up at the top, number one, okay? Because
It's not even a question. This is the most transparent, the best one, the one that you really get, you can really trust.
Good. You guys did what you said you would do. Very
Doing bull call spreads. Next, we have the bear call spread or the call credit spread. So a call credit spread is basically betting that the stock won't go up. You want it to stay lower because if it goes up, then you're going to end up losing money. Then, if you talk about the put debit spread, which you're paying for a put debit spread, you're paying for a put. If you're paying for a put, that means you think the stock will go down. Okay? I usually don't use this strategy, but you can use it for a stock that is going lower. Then a put credit spread, which love it, love it, love it, love it. You just saw an example of how a put credit spread can make you a lot of money. Debit spreads are for high volatility, expecting strong price changes, and credit spreads are for low volatility, experiencing or expecting little to no price changes in the underlying stock. For me, the best vertical spread that I typically do is going to have a $5 gap. For me, $5 is very simple. You can also use a $10 gap. And for some small portfolios, if you're selling put credit spreads, you can go for a $2 or $3 gap. Now we're going to get into the horizontal spread. Horizontal spreads are the opposite of vertical spreads because a vertical spread here is basically just two options that will have the same expiration date, but different strike prices. With a horizontal spread, your two options will have the same strike price, but different expiration dates. The different expiration dates being the key characteristics of this type of spread is why it's also referred to as the calendar spread. So if you hear the term calendar spread or horizontal spread, just know that they are the same thing. A lot of different strategies in option trading have multiple names, which can be really confusing, but don't worry, I'm going to explain to you as simple as possible. Anyway, there's a long horizontal spread, aka buying a horizontal spread, and a short horizontal spread, aka selling a horizontal spread. And with this spread, you can buy the calls and sell calls or buy and sell puts. However, I won't be covering short horizontal spreads because they technically have unlimited risk, and I think it's probably not necessary for a beginner course. We're going to start with the long horizontal spread, and we're going to use an example of specifically buying a horizontal call spread to help you understand. This strategy is generally used when you expect the underlying stock to stay relatively stable or to only move slightly in your favor. In order for you to buy a horizontal spread or pay a net debit to enter the spread, the long call that you're buying needs to cost more than the short call that you're going to be selling. If we know that only the expiration dates can be different, you can assume from what you've learned that the expiration dates affect the price of the option, that the long call has to have a longer expiration date and the short call because the longer expiration dates are more expensive. Let's say that Visa is trading at $280, which it is pretty close to that at the time of this recording of the video. And let's buy a call option at $279 and 60 days until expiration. Now, let's sell a call option also at $279, but with only 32 days until expiration. And for that, I'm going to receive $6 in premium. So in total, to enter this horizontal call spread, I'm paying $4 or a real price of $400. Now, as time passes and my two options start getting closer to expiration, I'm going to want the stock to stay relatively close to my strike price of $279. I'm also going to need to watch the stock pretty closely, so keep in mind that this strategy does require some management. To close this spread, I just need to do the reverse of what I did to open it. And that's true for a lot of different option trades. In fact, all of them. To reverse any trade, you just buy back or you sell back the trade that you opened up to begin with. So I need to buy my short call back and sell my long call. In order for you to make a profit, you have to sell your long call for more than you buy your short call for. And the reason why you benefit from the stock staying close to your strike price is because the theta decay will destroy the value of your short call much faster than your long call, since your short call has a shorter expiration date. Let's say in 32 days at expiration of your short call, Visa stays at the same price of $280 and your short call is now only worth its intrinsic value of $1, but it's lost $5 of extrinsic value. And your long call still has about a month until it expires, so it only lost $4 of extrinsic value, and now it's worth $6. So to exit, I'll make $600 from selling my long call and pay $100 to buy back my short call. That means I made $500. But we will still have to subtract what we paid to enter, which was $400. So my net profit for the spread will be $100. Overall, this is a decent strategy that I don't use all the time, but it can be really good for small portfolios because it's a really inexpensive strategy where you can make 20 or 25% per month. All right, now let's discuss early assignment in option trading. Basically, when someone exercises their right to buy or sell the underlying asset before the expiration date. So why does early assignment happen? Well, there's a few different reasons. First, there could be dividends. Option holders may exercise call options early to capture an upcoming dividend. There's also interest rates. So changes in interest rates can make early assignment also happen and could be more advantageous. However, I really wouldn't worry about interest rates because that's not something that's very common in the market. The most common is going to be intrinsic value. If an option is deep in the money, the intrinsic value may motivate early exercise. However, I'm going to show you an example how it really doesn't make much sense for someone to exercise early because the option itself is always going to be more valuable to trade than exercising it unless it's the very last day. In most cases, you do not have to worry about early exercise, but it is smart to avoid decay. Option holders might exercise to avoid further time decay on an option's value. However, again, that's going to be really rare because it's much better to close out an option and buy it back than to exercise it. You do need to be aware of dividend dates if you're going to be writing call options because for someone that doesn't have the stock, they may decide to exercise a call option so they can own stock and collect the dividend. Now, that is something to watch out for, but again, it's not going to be an issue unless you're in the last month. Then in that case, it's probably going to make sense for someone to exercise because the dividend might be more than the time value left on the option. So do pay attention to dividend dates, and if an option includes a dividend that's going to have the exit dividend date, for example, then if you have a covered call, it might be really smart to just close it out and just be on the safe side because the worst thing that can actually happen if you do have a covered call is if you do lose your shares and you have a gain, then you will have to pay taxes, which is not that ideal because obviously depending on which state you're in, when you do sell a stock, you have a taxable event. In all cases, it's just a question of is it a loss, which is pretty good, right? If it's a loss, then you don't have to worry about taxes. It actually helps you out up to $3,000 per year, but I'm not a tax advisor. That's just from what I understand. You can write off $3,000 in losses per year and the rest gets carried over. Or if it's a short-term gain, well, you have to pay short-term taxes. Or if you hold a stock for more than 1 year, then it's going to be a long-term gain. So in most cases, you don't really want to sell the stock because if you do sell it off, then you have to pay taxes. Even if you do lose a stock, you can just rebuy it back, but it will be called something like the wash sale rule. If you have a loss, then you buy the stock back. It's not going to count. But if you have a gain, well, doesn't really matter. You're going to have to just pay some taxes and then you can rebuy the stock. That's why for me, like the best strategy when it comes to option trading is going to be covered calls and selling puts. And I do hold until expiration. I'm typically not trading options on a short-term basis. And I'm trying to create long-term, steady, passive income in my case when it comes to trading. However, you want to see for yourself what is best suited for you because there are certain strategies where you can make a lot of money, like buying call options and spreads. And those strategies are worth it because because they are short-term capital gains, but they can make a lot of money. Now, I also want to talk about hedging because at this portion of the course, it's important for you to understand how to manage your portfolio in general. So we already learned the trading strategies. We learned about early assignment. Now I want to talk about hedging. So using strategies to hedge your portfolio, a hedge is basically just mitigating risk, reducing risk, or giving yourself less exposure into a really big position. So for example, let's say that you bought NVIDIA shares 2 or 3 years ago and it was 20% of your portfolio. Okay, so let's say you had $100,000, you bought $20,000 worth of NVIDIA, and now after 3 years, NVIDIA has gone up by 10x. So your $20,000 has turned into $200,000. And let's say the rest of your portfolio, the other $80,000, didn't really go anywhere. So now your portfolio is $280,000, $200,000 being NVIDIA and $80,000 being other positions. So as you can imagine, it's not that good in general to have too much of one stock because you're not properly diversified. Something that I learned in finance school when I studied finance. Basically, you want diversification. A good diversified portfolio has 10 to 15 positions. That perfect number is around 12. Because in risk management terms, 12 gives you that good variability in your portfolio in terms of like having different stocks giving you that upside, but also minimizing risk. And as you add more positions beyond 12, then your risk does go down, but you have something called diminishing returns. So diminishing returns basically is this. If you're super hungry and I offer you a cheeseburger, you are going to be very happy to eat that cheeseburger. That first one is going to be, let's assign a 10 out of 10 score. You're going to have a 10 out of 10 experience because you're very hungry and let's say you didn't eat for 1 day. Now, if I offer you a second cheeseburger, you are going to probably have 9 or 8 out of 10 satisfaction. It's still going to taste really good if you're hungry, but you're not as hungry. Now, the third cheeseburger, if you're full, is going to have a very small value. It's going to have a 3 out of 10. And then a fourth one is just going to not really be something that you want at all. So it might be a 1 out of 10. So the rate at which you are enjoying the hamburger will go down because you are less hungry. And the same thing applies with diversification. So if you have one stock, you have a lot of risk here, and adding a second stock will greatly reduce risk. Adding a third stock will also greatly reduce risk, but to a little bit lesser of a degree. Okay, and so on and so forth. At 12, you can think about it as having the 2 cheeseburgers. You're satisfied, you're good. So let's go back to the example that I used with NVIDIA. So if in NVIDIA, we have $200,000 worth of NVIDIA because it has grown so much and $80,000 worth of other stocks, then what you would want to do is you want to basically take some chips off the table. You want to take chips off the table because you have quite a bit of exposure into one stock. And even if you like that stock as an overall basket of your wealth, it's still good to diversify. So what you can do is you would sell covered calls. Now, we have talked about different deltas to sell covered calls. For me, I do like to sell 30 delta covered calls because that's the sweet spot that I realized works very well when I was working for Goldman Sachs. However, in this course, I want you to understand all the different deltas. If you go for a 10 delta, that's going to give you lots of upside and very little income because it's a low delta. There's a low chance of it happening. Therefore, it's very out of the money and you get a small amount of money paid to you and then a very high chance that nothing's going to really happen. And that's why there's a trade-off in finance. There's risk and return. Okay. The more you dial in the risk, right here in this case, risk will be higher delta because a higher delta means that it's in the money and an in the money option is higher risk than an out of the money option. So if we increase the delta and the delta is say 50, then that's going to be a high delta and you have a high chance of losing the stock. Now there's a risk of losing the stock. However, as a hedge in your portfolio, the reason why it's good is because you are reducing exposure into a stock that you have a lot of. And this is actually where hedging is really beneficial because let's just say, for example, that you have the $200,000 of NVIDIA stock. If you sell 50 delta covered calls on the entire position, you can theoretically say that you have sold half of your position. The reason is because a 50 delta is a 50% chance of losing the stock, right? It's a 50% chance of being in the money. And that means that 50 delta is effectively reducing your position by 50%. So So instead of having $200,000 in NVIDIA, which you will still have in theory, you are reducing your position by 50%. Now, this obviously is very volatile because options change in delta very drastically. I'm just telling you how to think about it. If you do sell 50 delta, then you're going to create income, and now you have a higher or high 50% risk of losing your shares. That could be a good thing or a bad thing, depending on if you're ready to sell the stock or not. You always want to ask yourself, am I ready to sell the stock? And if not, that's still okay, because later in this course, I'm going to show you what rolling options looks like. Now, you can also decide for yourself, this is a very smart and interesting idea, because I've seen this used at Goldman Sachs where clients have really big stock positions. You can decide to just sell covered calls at, say, 70 or 80 delta, which is a very high delta, for part of your position. So let's say that going to NVIDIA, you had $200,000 worth of NVIDIA. Well, let's say that you only want $100,000. Well, what you can do is, instead of selling your entire position of covered calls for 50 delta, you can sell half your position for 100 delta. That would be a little bit of an extreme case, but what you can do is you can just start selling 60 delta, 70 delta, 80 delta for part of your portfolio. Just make the math easy and simple for you to look at, and you'll understand quickly that by selling high delta options, that you're basically going to be losing part of your position, which is a good thing if you're looking to hedge. Hedging is very useful in general, but remember, the market does go up over time. So given that the market does go up over time, you don't necessarily really want to be selling high delta options. You usually want to sell out of the money options so you can collect income. And by collecting income, that's where you get consistency. So now let's move over to talking about an iron condor. We have learned what spreads are. An iron condor is a neutral option strategy involving 4 options, 2 calls and 2 puts with different strike prices, but the same expiration date. It consists of buying a lower strike put and selling a higher strike put, selling a lower strike call and buying a higher strike call. To set up an iron condor, choose strikes that encompass the expected trading range of the stock. Typically, the distance between strikes is equal. For me, that's going to be a $5 width. So before I show an example, I'm just going to tell you that a $5 width would be basically selling a 100 strike and a 95 strike, or a 105 strike and a 110 strike. I prefer to use increments of $5. That just makes it very easy. However, if it's a low stock, let's say it's $15, then I prefer to use increments of 1. So I might sell a 14 and a 13 strike, a 16 and a 17 strike. So for me, that's the way I use iron condors, and I'm going to go over an example. But first, I do want to talk about the risk and reward. The maximum profit is a premium that you receive, while the maximum loss is the difference between the strikes minus the premium received. Here's a profit loss graph to illustrate this. Now, the break even is calculating the break even points by adding the premium to the lower short call strike and subtracting the premium from the higher short put strike. Break evens are very important because it gives you an understanding of where the stock has to be for you to be profitable, and the break even point gives you an idea of where you will also be losing money if the stock goes beyond that point. Now, the ideal market conditions for an iron condor is when the market is steady. Iron condors work best in stable or low volatility markets where the stock is expected to stay within a certain range. Also, looking at adjustments and management. If the stock moves significantly, consider rolling the position or adjusting the strikes. Always have a plan for managing your positions. However, with iron condors, since they are 4 different legs, it is typically the case that you either want to leave the position open until expiration or simply close it out for a loss. Iron condors is very difficult because since there's 4 legs, it is pretty expensive for the bid and the ask spread to really adjust them, because as you close out a iron condor and open up a new one, again, you're going to be dealing with 4 different legs. So you might lose $4 to $8 to $12, right? If the bid ask spread even has a very tight spread of just 1, 2, or 3. So there are advantages and disadvantages. The main advantage is that an iron condor gives you very limited risk and very high reward. In fact, I made a different video on this channel discussing the tier list of option trading strategies, and I actually placed the iron condor very high. So look, the iron condor is very beneficial because you're selling selling both calls and puts, so you can collect a very large amount of money. Let's go into my portfolio right now, and let's take a look at a live trade for an iron condor, and let's go over several different examples. I'm going to show you an example right now. I'm going to show you break-even prices, and you are going to learn exactly how to execute the iron condor. Now, this is not a low-risk strategy. This is a medium-risk strategy, but you can make crazy amounts of money very quickly. So let me show you what this looks like. You're going to go ahead and sell put option. This is actually going to be very interesting because it's going to look very similar to a put credit spread or a call credit spread. And that's because it's actually the combination of both of those strategies. So if you've paid attention to what a put credit spread is, if you've paid attention to what a call credit spread is, this is just the combination of those two strategies together. Now, what I can do is let's go to the 210. And specifically, actually, let me show you how I use technical analysis. I'm going to go to Yahoo Finance and I'm going to pull up Apple on a chart. This is going to be important because the way that you pick your break-even prices or the strike prices is crucial for being successful on the iron condor. Now, check this out. You can see that Apple has gone up a lot, so it's actually not ideal to trade right now on the iron condor. So I'm actually going to go to something else because I want you to pick a stock that is more predictable for an iron condor strategy. So I'm going to take a look at NVIDIA right now, and NVIDIA is actually perfect. I'll tell you why. So I use the Bollinger Band, which is a period of 20 days and 2 standard deviations. This is basically the blueprint for what I use to understand where a stock is trading within. You can see right now that NVIDIA is right in the middle of its Bollinger Band. That means that the stock is neither expensive nor cheap based on statistics. The Bollinger Band just uses statistics to understand volatility and price movement. All right, so right now it is in the middle, and you can see the top of the Bollinger Band is 135. Guess what? When I open up an iron condor, my top end will be 136. And you can see the bottom of the Bollinger Band is 119.51. So guess what? The bottom of my Bollinger Band, or this is going to tell me that the bottom end of my iron condor is going to be 119. So basically right now, what I'm going to do is I'm going to pick these strike prices based on the Bollinger Band. I keep it super, super simple. This is all you need. You don't need any other technical indicators. Actually, you can see right now, oh my goodness, you guys can actually see right now that I actually have an iron condor, and looks like it's working out very, very well so far. I'm up $5,620 on the iron condor, and this is actually expiring in the next couple of days. So this has been a pretty interesting strategy that I've been running in my Discord community because I do focus on small, medium, and large portfolios. I'm coaching a variety of students. Majority are beginners, but I do have some intermediates as well. So let's start off with selling a put option. I'm going to sell a put option. Let's just say, pretty short term here. If you're watching this in the future, again, it doesn't matter. Just copy this logic, copy and paste it, and print money. Make money by copying exactly what I'm doing, right? Same logic, same thought process. Now, I'm going to sell a put option. I said that the bottom is going to be around 119. Now, that is actually a 20-day Bollinger Band, so I'm actually going to go out a little bit further on this options. Now, let's pick the 119, all right? So I'm going to go down, pick 119, boom, and I'm going to make this a $5 width. Okay, $5 width is what I like to do. So I'm going to, sell the 119, and then I'm going to buy the 114. All right, so this is a put credit spread. But now I'm going to open up a call credit spread because I'm going to be selling both sides. That's what an iron condor is. Now the top of the Bollinger Band is 135.95, so I'm going to go for 136. I'm going to sell the 136. Now I'm going to go ahead and buy. I'm going to go 5 up, right? I'm going to go $5 width, 141. So boom, now we have a short iron condor. You can see here how my maximum profit is 275 and my maximum loss is 225. So I am making literally can double my money in such a short amount of time by running this strategy over and over. As long as NVIDIA stock stays within this range, which again, based on the Bollinger Band, it is likely to do so, then you are going to make money, which is fantastic, right? If the stock goes up a little bit, down a little bit, you're still going to be in this green profit zone, which is amazing, right? It's very, very important to stay within here. Now, let's talk a little bit about the break-even points. Let's talk about risk management and how much you should allocate to the strategy. So in terms of break-even points, you will see here that if NVIDIA stock goes to 138.75, then basically you're going to start seeing some losses, right? On the downside, if it's 116.25. Now, why is it different? Well, it's different because you're actually collecting a lot of premium, so you actually even have more room for buffer to make money. Now, in terms of risk management, I would say that if it hits one of your legs, one of your break-even prices, then an iron condor is better to close out because you have 2 options that you're working with. In fact, 4 option legs that you're working with. So if it goes into the money, I just simply keep it simple. I don't roll it. I don't do anything crazy. I just close out the iron condor and I move on and I do it on a different stock. Now for allocation, this is also very important because if you have $10,000, you don't want to put all $10,000 into an iron condor position. That's because obviously there are risks and you want to be diversified in your portfolio. You can definitely make money, but you also want to not put all your eggs in one basket. So I would say that the iron condor strategy, if you have a small portfolio, you can put in, 10, 15, maybe 20% of your money in it if you're a little bit on the riskier side. And as you scale up your portfolio, this strategy should only be about 5% of your money because it is, higher return and higher risk. And they're just more better strategies that I consider my bread and butter strategies. All right. I'm glad that you guys now have seen an example on iron condors and how to profitably trade iron condors. Now, there's also several other factors that you do have to pay attention to. One of them is market sentiment. A lot of my students ask me, am I bullish? Am I bearish on a certain stock? Well, it's really important to look at overall market sentiment because it can help you in predicting potential market moves and making informed decisions about entering or exiting a position. The market could be very bullish and all stocks can go up even if there's no particular news. That could just be driven by human behavior because at the end of the day, the stock market is a game that people are playing. So it's important to look and understand market sentiment if you want to make more accurate decisions. Also, there are different reports that come out into the market which are very important to look at. So one of them being a GDP report, the other being unemployment rates. Okay, looking at how people are employed in the job sector is very important for the economy overall. When the unemployment rate rises, then that is a bad sign that companies will make less money. And when unemployment rates are very low, that means that the economy is functioning very well. And when the economy is functioning very well, then people have more money to spend into the economy, and that is a sign of strength in the economy. Now, interest rates are also very interesting because as interest rates rise, they become less useful for business owners to borrow money. However, savers can make more money by depositing their funds into things like CDs. However, higher interest rates is typically a bad thing for the stock market because you want businesses to borrow money and invest that money. However, the reason why the Federal Reserve will raise interest rates is because high interest rates will combat inflation because when interest rates are very low and everyone is borrowing money, we have seen this situation before and we see it all the time, there will be higher inflation because there's just so much money going around. So the Federal Reserve actually has a mandate. Their job is actually to keep inflation under control. And the primary tool that they use to combat inflation is going to be interest rates. Interest rates don't really rise in the short term, but they can be very different over a 5-year period. So it's important to look at, and interest rates do affect the market because it can freak out other investors. Next is inflation data. So inflation data, for example, the CPI or the Consumer Price Index will measure a basket of goods. So that basket of goods could be coffee, gas, housing prices, a typical ticket to the movies, or basically just the basket of goods that people typically buy. Inflation data is really important when you're looking at the stock market or trading options because inflation does affect the price of stocks. It will affect the consumer sentiment. So we have recently seen some manipulation in inflation data. Just being honest with you, you have to be pretty smart when it comes to inflation because if you look at something like education, the CPI, the basket of goods that we are looking at can change. So I believe that the US government took out, let's say, education or oil and gas or something can be taken out to kind of manipulate the data. So I wouldn't recommend you really pay a lot of attention to, but I do recommend that you just understand basically what inflation is because these indicators can impact market volatility and the price of stocks greatly. Also, looking at earnings reports and announcements. Earnings reports can make a really huge difference in a stock. For example, earnings can come out and a stock can move up by 20% or it can fall down by 15 or even 30%. You see this all the time because stocks move based on expectations and earnings is a very huge number. It gives you a good perspective on a company's financial health. So an earnings report is something that comes out on a quarterly basis. So quarterly financial results announced by publicly traded companies happen every single quarter. And those earnings events give you a very good perspective of the health of the company. Are they making more money? Are their revenues growing? Are their profits declining? Are the margin of the business improving or is it not improving? For example, if you look at Amazon, they have like a 3% profit margin. If it went to 4%, that would make such a big difference because Amazon has hundreds of billions of dollars in revenue. So a 1% difference would add a lot of money to their bottom line. So that is something that I do pay attention to. But again, all of these different things are important to understand, but option trading doesn't have to be super complicated. You don't have to look at all of these metrics all the time. But I want you to be aware that earnings reports are very important. And me personally, I use OptionsFi as a software to track potential earnings beats, because an earnings beat will make sure that a company probably rises and then you can make a lot of money. However, I will also say that just because I use OptionsFi software and